If you have a universal life policy, and if you bought it in the late 90s or early 2000s, this video is particularly very important for you. Universal life policies are great when set up correctly and maintained and monitored correctly. Now, what you need to ensure that you're doing if you own a universal life policy is reviewing that policy on an annual basis. I've seen too many times when a person buys a policy and they don't look at it for 10 or 20 years, and at that point they finally decide to retire or take a look at it, or they get a surprise letter from the insurance company, do a review of the policy, and it is in a position where they absolutely do not expect it to be. So I just had a meeting with a client with universal life policy, so I thought that I would tell you how they work and why it's important for you to review. The great thing about universal life policies is that they're very flexible and they allow you to what we call dump cash into the policy to grow tax sheltered. However, when you set up your universal life policy, you have a decision to choose what type and cost of insurance that you would like to implement. There's two main costs: yearly renewable and level cost of insurance. Now, level cost of insurance means that the cost is never going to change from the point of time when you bought the policy to when you pass away. Yearly renewable term, however, increases in cost on an annual basis. These are the types of policies that run into trouble, and I often see in most cases blow up because the rate of return of the cash value within the policies do not perform like you have expected them to. So if you bought your policy in the late 90s or early 2000s, rates of return that I see most advisors and most clients wanting to project within the policy was 8%, maybe 10. I've seen even upward to 12 or 15% return of the cash. Now, this is just a projection of what you think the policy is going to perform at. But if you look at the average rate of return of the equity markets in the 2000s, the average return is about 3.5%. When we've seen most of those policies projected at 8, 10, or 12% return. So when you think about 8% on 8% on 8% on 8, when you compound that over the 40 years you might own your insurance policy, there's a lot of cash value. But when you're getting 3.5 and expecting to get 8% compounded or higher, your policy is in huge danger to completely lapse and blow up. So what you need to do is, if you own a universal life policy, is ask your advisor or your insurance company for what we call an in-force illustration. You still have to choose what rate of return you'd like your cash projected at, but what you'll be able to see is the policy today projected out on an annual basis from now until a life expectancy that you choose. So what I'm seeing today is many of those universal life policies that were set up with annual increasing term insurance, they are projected to blow up. And the reason being is that clients now, when I ask them what rate of return they want their policies projected at, they're picking somewhere between 3, 4, 5, maybe 6% max rate of return projections. But you have an option. Even if you get your illustration back and it is projected to lapse, have all the cash value completely be depleted, you do have the option to change the cost of insurance over to level cost with just a signature. It may cost you more, but in the long term, over the life of the policy, you may be in a better position. And something important to note, your advisor will not get any compensation or commissions for making the change within the insurance policy. So you can feel the comfort of knowing that if you do make a change in your policy, it's for the benefit of you and nobody else. So I urge you today, if you own a universal life policy, to immediately get an in-force illustration projection completed and really understand what your policy is going to look like over the projected lifetime.